Good morning, guys, and welcome to another episode of the mentorship program. And today we'll be talking about liquidity and bias, a surgical approach. Liquidity refers to the ease and efficiency with which a currency pair or asset in the market can be easily bought or sold without significantly affecting the price. So it refers to the readily available demand and supply for a currency pair. That is, the currencies are readily available and sufficient traders are willing to trade them. So, by this crude understanding, liquidity just simply means money, the amount of an asset or a currency pair in circulation that can be easily bought and sold for effective transactions. Liquidity is the lifeblood of the forex market. Due to the nature of the forex market, that's the volume of participants and providers. It is important that transactions are settled quickly at a price closer to the real market value, and that's where the importance of liquidity comes in. So, participants, sellers, and buyers participating in forex market, it's better that each of their orders are settled as soon as it can be settled and closest to the real market value. So, liquidity providers are institutions and individuals that quote the buy and sell prices for currency pairs. They help to ensure market efficiency by constantly providing bid and ask quotes. They ensure offers are always available for traders, and as a reward for their contribution, they earn a spread. So they are institutions and individuals that provide liquidity for currency pairs. So they quote the buy and the sell price. That's why when you check the charts, when you check your trading terminal, you see a particular side, which is the bid and the ask price. So, and the difference between the bid and the ask price, as you know before from the past lecture, is the spread. So, and liquidity providers quote these prices. So, and they also they constantly provide the bid and the ask quotes. So the ensure offers are always available for traders. Offers are always readily available for traders. So no matter what the amount of offers you're bringing into the marketplace, no matter how much positions you want to hold, it's readily available. And as a reward for their contribution, they earn a spread. So here are the two main roles of which a liquidity provider functions. One, the market makers. A market maker is one of the most common form of liquidity provider and plays a crucial role in the financial market. The function of a market maker is to either continuously buy and sell a particular asset or security, thus providing stability in a particular market, as it ensures there is always someone to trade with or provide enough liquidity to ensure a trade can always be made. So, one of the functions of the market maker is actually maintaining two price quotations, the bid and the ask. So that means they must ensure that there is always the bid and the ask positions for a particular set of standard lots at each point in time in the market. So that's one of their functions. And another one is to maintain spread. So another function is they must maintain a certain number, a certain like discrete range of spread. So if the bid and the ask, the difference between the bid and the ask, let's say for the euro, we have like there are sometimes that we see 0 1 point spread, 1 point spread, 0 point spread, 2 point spread. Until maybe when there's like a volatile volatility is entering the marketplace, maybe due to news, a financial news, and it's heavier than usual, then we see 4 5 6 point spread. So that's another function of the market maker. And then another function is to make sure that there is no pauses or interruption in the marketplace. So it's not that there are buyers then waiting for sellers, or there are sellers then waiting for buyers. But as the case may be, the way the market operates now is through algos. So the liquidity providers have algos that's pool price at every point in time of every trading day. The algos keeps pulling prices at each point in time. So that's that. So they can also act as brokers. A broker is an individual or an institution which has someone buy or sell an asset, such as a stock or currency. So a broker does not purchase the asset themselves, rather they connect buyers and sellers, often serving as an intermediary between retail traders and the wider financial markets. In this way, a broker provides access to liquidity but does not produce the liquidity. In the sense that they only connect buyers and sellers. So the buying side has liquidity, the selling side has liquidity. So they do not produce the liquidity, they only connect the buyers and the sellers together. So that's the function of brokers. And then skipping all that because at the point you'll be bored, like, oh, it's just theoretical aspect. What is concerned with the chart? Going to liquidity pools. Liquidity pool refers to specific areas on a price chart where liquidity, either buy side or sell side, is concentrated. You're going to understand buy side or sell side liquidity. And if you watch the last video, the last episode of the mentorship program, I told you how you find out buy side and sell side. So, by recognizing where liquidity accumulates, traders can enter and exit trades with greater precision. So, thus reducing risk and increasing the likelihood of profitable outcome. So, let's say price is gravitating to the sell side, and that means price is going down. So, where you can always target where liquidity accumulates. So, you can either enter a position after the market has taken liquidity if you have other targets to get paired with your daily buyers and your technical analysis, or you can follow how price moves to target that liquidity. So in the sense that you can enter a trade at the liquidity point, or you can exit your trade at the liquidity pool. So in essence, a liquidity pool acts as a magnet. Yes, this is the main thing. Act as a magnet, attracting price action to these levels and often leading to reversals of price sharp movement. So the liquidity pool will act as a magnet where price will either gravitate or elevate to. So that's how liquidity pools work. If the price is going for buy side liquidity, the buy side is like a draw on liquidity, a magnet on liquidity, where there's pool of buy side or sell side. Bullish liquidity pools now. Bullish liquidity pools are areas on the price charts where smart money traders look to buy or exit their positions. And types of bullish liquidity pools we have lows, equal lows, and equal lows. And below the old or equal lows, sell side liquidity rests in the form of sell stops. So let's say traders that took trades at that particular point, expecting market to gravitate upwards at that particular point, that particular low. Their stop losses, their sell stops will be below that low. Most traders do that. Their stop losses will be below that low. And so if price may have gone up, peradventure might have gone up and then it's gravitating downwards, then and smart money they are currently in a position, expecting price to gravitate and hit that liquidity target, that means they are selling. They are currently in a sell position. And so the only way to offset their position, to take their positions off or to close their position is to buy. Since they are selling and expecting price to gravitate downwards to those sell stops, the only way is to buy. And so what would they be buying? They'll be buying into the sell stops at that sell side liquidity. That's what they'll be buying into. And in the same vein, if they expect that price will gravitate to those that sell side liquidity and then it will reverse and go the other way. So all those that set their sell stops, their stop losses at that low, old low or the equal low, they are going to buy into those sell stops. They are going to enter positions on those sell stops. So buy into those sell stops. So that's what they are going to do. So these areas can serve as a source of entry or exiting a trade, and they can also be used to form liquidity, to form trading bias. They can also be used to form trading bias in the sense that if price is gravitating to sell to the sell side liquidity, to a sell side liquidity where sell stops rest, and after breaking every bullish structure that could have sent price back the other way, and price is gravitating to a sell side liquidity, all what you have to do is trade according to the trend to eat those sell stops, to eat that sell side liquidity. And most of the time, after the market takes out the major sell side liquidity, there's something called like a rebound, where price will be like alpha, like there'll be like, let me call it a shake. After they take out the sell side liquidity, there'll be like the next trading day or the next will be like a reset in price where price will try to gravitate up if it's taking out the sell side liquidity. They'll try to gravitate upwards, try to move up. But if there's now your other targets lower, then after moving up, that's retrace. They can retrace a bit and then send it lower. Or if price wants to reverse, from that point they can start reversals. So you can form a trading bias on that. That's a major core of what you'll be learning in this mentorship program. So this is also an example of the sell side liquidity and old load has been swept, and then the markets, after sweeping that old load, then goes bullish and breaks every bearish structure and go up to the high of this price leg. So looking at it very well, that particular position, their stop loss residing below that. Look at how they sent the week of the candle down to take out that shaded area when price came to it. Take it out, come all the way down to sweep it out, and then price going the other way and gravitating upwards. So if you are following that price leg down to take out that sell side liquidity, you'll be bearish on that particular trading pair. You'll be bearish, expecting it to go down to sweep that liquidity target. But immediately you sweep that liquidity target and price start gravitating upward, you can then target, okay, should price go upwards? What are the things you'll be seeing that will confirm whether price should go upward or not? But this is the main idea of the sell side liquidity. This is a bullish liquidity pool. So bearish liquidity pool now. These are areas on the price chart where smart money traders look to sell or offset their positions, offset their buying positions. So, types of bearish liquidity pool, we have the old highs and the equal highs. And above the old or equal highs rests the buy side liquidity, which rests in the form of buy stops. So above the old or equal highs, there are areas where buyers entering trades around that region will put their stop loss, expecting price to gravitate downwards. So when price start going up to those areas, it will eventually take out their stop losses. And then there are breakout artists. Breakout artists. I failed to mention that in the bullish liquidity pool. They are breakout artists where they think that okay, if price take out an order and then start going up more, they will enter the trade. So entering trades and then expecting price to keep going up more. There are times when the market will just take out that buy side liquidity and then will reverse. So after it reverses, they will all run into losses. So don't be a breakout artist. The same thing for the bullish liquidity pool where they said if price break below and not low, then price should start gravitating downwards. And so they will be setting their sell orders below the old low. So if price breaks that and then it will tag them in and then you can just see they'll start expecting oh the market should keep shedding more. But price will reverse on there and then take them out. Get their claws cleaned. So don't be a breakout artist. You know the idea, you know the premise. Don't start printing price. Don't start printing the candles in your head. You're not the one printing the candles. You're not the one drawing those fancy lines on those green and red candles. You're not drawing it. Every fancy line you draw on the chart, it doesn't make any difference. So the bearish liquidity pool, these are areas that can serve as a source of entry or exits in a trade. They can also be used the same way the bullish liquidity pool was used. They can also be used to form a trading bias. This is an example of a bearish liquidity pool. After the market took out the old high, after gravitating upwards and taking out the old high, that's the high in the shaded portion. You see the displacement going down. Look at the last two down close candles, those big last two down close candles. After they took out the old high, that's the red candles. The displacement going downward and then the retracement and more sell-offs going downward on the right hand side. So this is an example of the bearish liquidity pool. These are how the market books the liquidity, the buy stops at these positions. External and internal trade range liquidity. External range liquidity refers to liquidity outside the current trading range, such as buy side liquidity above range highs and sell side liquidity below range lows. These are liquidity found at the extremes of a price leg, while internal range liquidity refers to liquidity found within the current trading range. These are liquidity found within a price leg. They can serve as targets for retracement level. They can also serve as entry and exit positions. So this is a past representation of how prices have been booked. Look at the external buy side liquidity and the external sell side liquidity. How price navigates them, how they book each of the internal liquidity and then form a new dealing range, external buy side liquidity and the new dealing range, external sell side liquidity. So this is like a this is like a past representation of how prices have been booked. Liquidity void. This represents significant abrupt price movement between two levels on a chart without the usual gradual trading activity in between. This was a visual representation of moments when the market experiences a temporary absence of balance between buyers and sellers. This imbalance leads to a sharp move as the market seeks a new equilibrium level. So this essentially means that there are moments where the algorithm just pulls buys or moments where the algorithm just pulls sells. So price will just keep gravitating upward with massive displacement, velocity and displacement. So gravitating upwards or downwards with velocity and displacement. This can happen during news news during release of news like the CPI, the FOMC, the NFP. So during this, there is the absence of the balance between buyers and sellers where this particular price point is both filled with both buyers and sellers. It's just all buyers at a point or all sellers at a point. Looking at this example of a liquidity void, we see that this is a buy side liquidity void in the sense that the only thing that the algorithm spooled here was sell side. There wasn't really much of a balance between buy side and sell side here. It was just the market gravitating downwards, price gravitating downwards, algorithm pulling sells and sells and sells to send price downwards. So this is an example. Going now into bias, which is like one of the cornerstones of what you'll be learning. Bias is defined as a predetermined disposition of one position over another. So that means you can have a predetermined disposition over a particular on a particular trading day, particular trading week, or a particular trading month, thinking, okay, in this particular trading month, due to the price trying to seek this particular liquidity point or try to offer fair value or rebalance an imbalance, we can see order flow going in this direction. So having a bullish or a bearish bias. You can only have two bias. Either you have a bullish bias or a bearish bias. Bullish bias in the sense that okay, targeting this particular liquidity point or rebalancing this imbalance. Or bearish bias targeting this particular liquidity point and also rebalancing an imbalance. So prices can only go up or down at each particular point. You can only have up or down. And then gamblers will think of since it's 50-50, that means I can expect price to go up or to go down. Then they just close their eyes, roll it, toss a coin, and then pick one direction. Sometimes it works, sometimes they get smoked. So bias helps you like fine tune what to look for in the marketplace. Because there are times when there are a lot of times, not even times, a lot of times when the market just for bullish structures and bearish structures. But if the market is bullish, your bearish structures will fail. And if the market is bearish, your bullish structures will fail. That is just the truth. That is the gimmick. That is what most traders fail to know about the market. If the market is offering bullish spoolings, if the algorithm is bullish, your bearish structures will fail. And if the algorithm is bearish, all the bullish structures will fail. It is as easy as that. Every bullish structure will fail if the algorithm is bearish. And if the algorithm is bullish, every bearish structure will fail. So to identify correct bias, you need to check the following elements. You have the monthly, the weekly, or the daily time frame order flow. You have the imbalance in terms of maybe a liquidity void that price will maybe eventually come back to like fill. They might not fully fill the liquidity void. Sometimes they might just full fill up the consequent encroachment. That's 50% of that void. And then there might be a drawn liquidity also that the market is targeting. Maybe there is buy stops at particular position or sell stops at particular position that the market is trying to navigate to. So they can help you in forming a correct bias. And if you look at the previous things I've been saying on this video, I told you, and the bullish liquidity pool, even if price hasn't got into that bullish liquidity pool, and if it's a daily or a weekly or monthly time frame, you can frame your trades on okay, let me start looking for long trades. Or in a bullish liquidity pool, let me start looking for short trades. In the sense that okay, the sell stops, you have to target that. And in a bearish liquidity pool, let me start looking for long trades to go and take out those buy stops. So that is it. That is it. So this is An example of determining bias, you can see that first line is where the buy side liquidity was being pushed. You can see how the market sent the week to it. Price went up there, took out the buy stops there. This is actually a daily chart. Took out the buy stops there. This is a daily chart on the Euro USD. After they took out the buy stops, then the market broke downwards, break a structure. And what is called by market structure shift, that's the MSS. BS is a market structure shift. I told you when we are in the previous video, when we have an uptrend, the lows are always going to get protected while the highs will get violated. That means you'll be forming higher lows and will also be forming higher highs, leading up to that buy side liquidity that was formed. You are forming higher highs and higher lows. And then after the buy side liquidity was forged, the retracement level that that price leg formed, it was taken out. The second to the last candle here on the left hand side, the second to the last candle. That red, big back red candle took out that low. Immediately they take out that low. That is showing you what? Oh, market structure shift. The lows that should be protected in an uptrend has gotten taken out. So do they want to go bearish? If they want to go bearish, these are liquidity targets. These are lows. These are positions where sell stops are, that can be taken out. So these are positions where sell stops are that can be taken out, and then the markets may gravitate to take out all of that. And you're going to see that in the next. So that was the terminus where the market gravitated to each of the sell stops and took each and every of the sell stops out. Each candle you're seeing is actually daily, just because of the way I cropped it out just to explain this. The market gravitated to each of the sell stops. So if you're expecting these sell stops to be taken out, definitely what your bias would be day in, day out would be, let me see sales to take out those sell side liquidity. So you're expecting price to go lower day in, day out. One of the things you can target is the previous day's low. One of the things you can target is the previous day's low. That's a good draw on liquidity. If the next price is going to go lower than, if the next day is going to also be a red, that means they are going to take out the previous day's low. So that can be one of the things you can target alongside the sell side liquidity you're targeting. So alongside the sell side liquidity you're targeting, the sell side liquidity you're targeting might be, you might eventually get there maybe in days. But if you're targeting previous day's low, that might even be a low hanging fruit for you that you can just take that previous day low and you're done with trades. So this is what bias does. Bias help you to fine tune your direction. It's not that you, if you expand all these charts and you take it from the daily to, let's say, the 4 hour to the 1 hour, you are going to see some bullish structures in it that got violated, that didn't work out. So if algorithm is pulling cells, if the daily is showing cells, if the daily is showing or the weekly, they are targeting a particular liquidity point, then you work according to that. Don't just try to be like, oh, I want to grab a falling knife. I want to grab a falling knife, or I want to use my hand to close a bull candle. In case it's going up, price is going up. I want to use my hand to close a bull candle, you get bumped. I want to grab a falling knife, you get caught, and your blood will spill. So that's how it is. That's how the market operates. So see you next time, folks. Have a lovely day. And the second video will be something teaching you. Will mainly be what it will be less of the chart, less of the slides, and more on the chart. I show you how these things have been applied, how these things work out on the chart, how to effectively form a bias that way. So, see you next time, folks. Have a lovely day.